All right, there, Canadian wealth secret seekers. Today, we're going to be digging into, and we're gonna try to keep this short. I know, John, you and I
I don't
are
think you've ever done that before.
notorious. I know, I don't think it's ever happened. We're notorious for getting a little bit deeper than we intended to. But we wanted to chat about something that we've been hearing a lot from both those who listen to the podcast, but also others, specifically business owners and investors who reach out to us on a regular basis. I have calls every single day.
Mhm.
We chat about different strategies, specifically around strategies that help us to essentially grow that financial foundation, but then also to do things in a more tax efficient way. So
Mhm.
today,
Mhm.
we're going to talk about something that we get from specifically those who are incorporated business owners or investors, those who have companies. And we advocate this idea of building wealth machines out of our companies, right? Instead of, say, draining money out, which is kind of what our tax system is sort of structured to do. It's sort of, it's sort of designed such that, hey, there's incentive at the beginning. I like to call it the bait and switch, right? At the beginning of the journey, when
Mm.
you're earning active income inside a corporation, it's like, man, that 12.2% here in Ontario and, slightly less in different provinces around the country, that 12.2% on the first $500,000 of profit is like, wow, that's awesome. I'm going to open up a company, right?
Right.
Because that makes sense, especially in the growth
I
stage
can
where
write stuff off.
I could write stuff off. I mean, you could write stuff off personally, but remember, at the personal level, if I get $500,000 of income as a sole proprietor and I'm not incorporated, I'm going to essentially gift away around 50% of that, right? So I'm going to have a lot of expenses to make the profit like much
Yep.
lower. Or and really to get it down to 12.2%, you're gifting a lot of it in expenses, right? So you're just letting money fly out the door. So it totally makes sense to get that money earned inside the corporation actively. But here's the big challenge, and this is probably the biggest challenge that we help business owners to solve here at Canadian Wealth Secrets, is they come to us and they say, I've earned $500,000 in net operating income, or in some cases it's a million, or maybe
Yep.
it's more. Or you might have the case where someone says, listen, I don't earn 500,000 every single year in net operating income, but over the years I have accumulated retained earnings of, say, $1 million, right? And in
Sure.
a lot of cases, John, what people end up doing with these retained earnings is they either they take them all out and then they get hammered in tax, right? They
Sure.
pay
Yep.
that 40-ish% in dividends, or you can take salaries and try to be a little more strategic, some salaries, some dividends. We've got episodes all about that you can go back to, talking about should you pay yourself a salary or dividend, back on episode 66. But like today, let's talk about, if we don't want to get hurt by that tax on the personal level by just bringing the money out,
Right.
I've got this money in my corporation, and we've said it on many episodes before around how permanent life insurance provides an opportunity for business owners specifically to really save on the taxes that they're going to pay both now, but also in the future for their estate. So that's kind of where we're going to frame this
Mm.
conversation here today. And we're going to
Mm.
dig into what do we do? And if we start to consider permanent insurance as a strategy inside of our corporate structure, like how big should that policy be? Like, should
Right.
I be putting all of my assets inside of a policy? Like, should I be taking capital gains and putting them in? Like, what should I be doing? Because we get
Right.
this question quite a bit. And today we want to
And how
set
does it work?
some,
Like,
yeah, we want to set some bumpers, right, for people to be considering when they look at their own corporate structure and they look at their balance sheet and sort of go, okay, how do I do this better?
yeah. And you know what? When you said, something that popped into my mind, and I know that this has always been hanging around, but it's the same issue on the personal level when you've been stuffing money into the RRSP, and you're like, now I'm at a place where I'm like, I want to get that out, and it's like now I'm in actually a higher tax bracket than I was, and how do I
Mm-hmm.
get that out without getting this huge tax burden? It's like the same with like this retained earnings. It's in there. It's been growing in there. And now I'm like, okay, well, what do I do with it? Like, do I continue to keep it growing in there, and I'll continually pull some out at an appropriate tax amount to keep my lifestyle going. But it's like, but if you're in it, like the good problem to have is like it's gonna get bigger. So it's
Right.
like eventually it's got to come out of there somewhere, or I'm selling this business with these assets included, or am I going to pull this out personally as a shareholder? Or am I going to all of a sudden do some sort of distribution? Like there are different things you could be doing with the retained earnings, but you're right. Most people are coming going, I have opened a corporation. It's either like I'm the owner's sole owner, or I have one other partner, or my spouse is the partner or shareholder in that corporation, but now I want to bring that money out, or try to like go, what is my strategy to get it out and eventually go
Hmm.
live on it? Because it's like I don't like, could I just start withdrawing some every year and slowly deplete it? But then what happens if I can't deplete it fast enough? And I don't want to
Right.
gift it all away to the government. Like, what are some of the strategies that we're trying to employ? So when you say like, this is where the turn to saying permanent life insurance is a tool for us to kind of go, we can minimize that, but it's like part of that is like, well, I still like I'm going to own the life insurance in the corporation, but that it's
Mhm.
all still up in there. So I think lots of questions around like how much should I be doing? What is the minimum? What's the maximum? And then but then I think the other question still is going, well, how do I use it like because I think business owners are like, I'm using this cash or wherever these assets that are sitting in the corporation to grow, but if the main question is still for these people is how do I get it out of there? Like how do we structure that, and what is the my mind always goes to like the logistics. Like, tell me
Mhm.
what that looks like. Do I take the money out of this account and it comes over here? Or like, what are some of these moves that we make that makes me feel like, okay, I've got a plan moving forward. I'm going to like make my spreadsheet and it's going to show that in year 10, I'm going to be withdrawing this from that account. And that's going to be able to continually pay my bills.
100%. Yeah. And, just to speak to the RSP, I know we talk about it like for business owners. Now, if you're not incorporated, you're a T4 employee. Again, we've said it time and
Yeah.
time again. An RSP is a really good move to a point. There's always a point at which maybe the RSP gets too big, but let's be honest, for the vast majority of Canadians, they don't get to that place if they're a T4 employee, right? It might be something you consider if you already have a pension that maybe you're going a little less into your RSP. But let's be honest, you also don't have as much room because your RSP space is taken by your pension contributions, right? That you're making throughout your life. So in that regard, we're talking specifically about business
Yeah.
owners and why we don't promote the idea. It's not bad necessarily to take money out of your corporation as a salary, which opens up room in the RSP, and then you put it in there, and then you get this tax kickback. I would much rather, first of all, if I'm growing assets inside of my RSP, I'm probably going to be picking more long-term type growth assets in there. You're actually losing some of the capital gains exemptions or the gap capital gains inclusion rate. So right now it's still 50-50. In September, the government's going to, sort of decide whether this June 25th date is actually going to go forward with the 2/3 inclusion and so forth. But in your RSP, you're getting 100% inclusion rate. Now, the tax is deferred, but so is a capital gain. A capital gain is deferred until you sell it. So I would much rather see that capital gain growth asset happening inside my company because I actually am going to get essentially the same result unless you are in that under $250,000
Right.
exemption on the
Right.
personal level, right? Now, there's a lot of acrobatics that have to happen for you to pull the money out of the corporation and then, and really analyze like, can I make this work where I'm still under the personal amount of $250,000? For a lot of business owners, it's probably not you. So you're going to be dealing with a higher inclusion rate regardless, assuming this all goes through. So what I want to do in my company, though, is I want to think about the different types of income that my company actually is producing. Because really, you've got kind of like three different options here. Like you have active income, which is that's the big one. Like for us, when we earn active income inside a corporate structure, you are getting a tax incentive to earn that active income. Up
Right.
to the first 500,000, you pay that 12.2 here in Ontario. Again, very similar rates, slightly lower in other provinces. As you get above 500,000, that number goes up, but still not as much as you'd be paying if you were a sole proprietor, 26.5%, right? So it's still better to be earning that money. But here's the challenge. The challenge is that money that you actually earn as profit inside the company and you do not take out as a salary or dividend is now retained earnings, right? So you now have excess money in this company, and you really have essentially two options. You can buy growth assets that produce a capital gain,
Yep.
or you can buy passive income type assets that produce some sort of interest or
Right.
passive income.
Right.
Passive income is what hammers you, right? You get 50%, 50+% in passive income taxes. Of course, you take that money out after, you're going to get a bit of a credit and those sorts of things. So again, not really pushing on this passive income part, but if I throw it into a capital gain asset, so I buy real estate or I buy growth stocks or just the index and so forth that isn't focused on getting dividends, I can grow that capital gain. And of course, there's going to be a 50 or 2/3 inclusion, depending on what happens here over the next little while. I'm going to have that inclusion rate, but the difference is that it's going to happen essentially the same way, whether it's corporately or personally, unless it's under that $250,000 mark, right? So you can be strategic about it, but the problem is when I pull this money out, I'm getting hammered at the front. So what we would rather do is we'd rather look at this and go, okay, I've got some problems. The money I earn in the company actively is sort of stuck in here and I can invest it. But before we invest it, we want to find a way that we can allow for a nice opportunity for that actively earned income to come out in a more tax efficient manner, both while I'm alive and when I move on. Because the reality is, I want to give like a scenario here. Okay. You have $1 million of retained earnings. You earned it actively, right? And let's say it was all at the lower tax rate. So it was earned over a few years.
Yep.
Those are 88-cent dollars in that company. I could purchase real estate or I could purchase growth stocks. I can do all of these things in here. So I'm using this cheaper dollar. I can grow that capital gain. But the problem is let's say I take that million and then I turn it into 2 million.
Okay.
I have $1 million of retained earnings that still has to come out of this corporation at some point in the future. Right?
Yes.
I don't ever have to take it out, but then it's stuck in there. But then I also have this $1 million capital gain. I could pay the capital gains taxes and then take some of that money out tax-free. That's a good thing. But I still can't solve this $1 million retained earnings issue. So what we want to share with our business owners here in this particular episode is that if I focus at minimum on getting my retained earnings over time, whether it's year over year or whether it's trying to deal with a large amount of retained earnings all at once, what we can do is we can actually structure it into a permanent policy, which we know will pay out. The net death benefit will pay out to the shareholders tax-free down the road. That's a bonus for sure. I can essentially take that million and it'll actually be much more than $1 million. It'll come out tax-free instead of turning the $1 million into 600,000, let's say, if I take it out.
Okay.
And I have the opportunity to leverage against that bucket in the interim to buy more capital gain type generating assets, be it real estate, be it, and now mind you, real estate will produce a passive income, but with all the expenses that are associated, you can design it such that you're minimizing the passive income taxes. And actually, let's be honest, there's an opportunity for us to funnel some of that passive income into policies and use leverage strategies to create an additional expense to reduce that passive income tax over time.
So when I'm thinking about, say, some of these logistics, and when I think about that million, let's say we create a plan in a schedule to eventually shift in a way that retained earnings into a policy. So you're paying premium every year, and some of that million goes into the premiums of that policy. The cash value of that policy is increasing. Um, uh, the way that you just described that is the only way that I can pass that on is when I die. And I think that's where people like start to go like, but don't I want to have that just in case? Or like,
Hmm.
and it's like, so there is a policy there and therefore cash value, but it's still inside the corp, right? It's
Yeah.
still, the corp still owns this asset that has grown um, more than the million, and because of the cash value is going to increase. It is a dividend paying, let's say it's a dividend paying whole life insurance policy. Um, then it's like, okay, if I die, the death benefit is going to be passed tax free to the shareholders. I get that. That's great. All of a sudden that million is outside the corp now, and it's in the shareholders' hands. But what happens if I wanted to use it while it's still there?
I love it. I love it. In some cases, what we have, John, is this opportunity where we use leverage. So, us being real estate guys, leverage is something that isn't, a scary thing to us. Now, for those who
Yeah.
have never, leveraged anything, or they're still sort of stuck in this idea that, hey, I got to pay down the mortgage and have zero debt. Totally get there's an emotional,
Right.
side
Right.
to that people have to work on for mindset. But imagine this world where over time, as we build this policy, which is a corporate owned asset, that policy is owned by the company. But you
Yep.
know what's really interesting, John, is that you own the company.
Yep.
So when I want to leverage against that policy, there's different ways that we can do it. But one of, I'll call it the easiest ways, is that I could fund this policy. And this is what, you, myself, and Matt have been doing for a little while now is we've been building these policies. We leverage in the company to buy more assets, which
Yep.
creates more tax problem on a capital gains perspective. But there's this big death benefit that's going to help my next, the heirs of this estate down the road. So that's a benefit, not the real reason why I do that. But what I do know is that my balance sheet on that company shows that the asset in the company is growing,
Mm-hmm.
and banks love that asset because it's such a safe asset. Like imagine a world like usually what a bank says when they want to borrow against real estate, they say, hey, I need an appraisal. Right. And they
Sure.
know the appraisal is kind of like, well, it's kind of like based on comparisons or it's based on the income approach. The reality is an appraisal is just an opinion based on some methods. Whereas with a policy, it's like you get a daily appraisal and it's
Right.
exact because we always know exactly what the cash value of that policy is worth. And banks know this, and banks love lending against it because you know what happens, John, if you don't pay? The bank says, give me the policy, right? So just give me the policy because I know what it's worth. And that's pretty easy. They don't have to foreclose. They don't have to like list it. They don't have expenses. They
Sure.
don't have this timeline. None of that stuff. It's very, very easy and simple. So, from the easiest standpoint, while we don't always use this method, we have more complex methods which allow you to leverage directly against that corporate asset and do it in a compliant fashion. But you think about this, John, you go, hey, I go to my bank or any bank really, and you
Sure.
say, here's all my personal assets, including the shares of these companies that I have or a company or whatever it might be. The bank goes, wow, okay, you've got a good thing going on.
Right.
Okay. And then you say, hey, will you allow me to leverage? Would you give me a line of credit or would you give me a loan for X amount of dollars? Right. And they will usually say, yes, look at all of these things. And you can do that and secure it against all your personal assets, which is one option. That's the easiest option because then there's no nuance from a CRA perspective. Like, hey, these are my assets and the bank's willing to lend it to me.
Right.
Well, what I can also do is I can go a step further and I can actually go, you know what? This one asset inside this corporation over here, this policy, it's worth this much today. And it's going to be worth more tomorrow. And it's going to be worth more next year. And I'm going to continue to fund it. The bank will actually allow you to collateralize that particular policy. Now, there is a little bit of acrobatics required from a CRA perspective because we have to make sure there's no shareholder benefit here. So we have a process that we use
Right.
to make sure it's compliant. We send people away for an independent tax opinion so that you're protected and you've done your due diligence and all those wonderful things, but you can actually secure it against that thing. And then I have this bucket of money that, even though quote unquote it's a loan,
Yep.
that I'm borrowing from the bank, the reality is that I'm borrowing it tax free and at an interest rate that I'm agreeing to with the bank, right? So if it's prime, right now it'd be 6.95%. So 6.95%, a lot of people go, oh, geez, that's like way too high. That's way too high. Well, guess what's higher? 39% dividend tax, right? So I'm able to use this. Now, of course, you want to make sure that your plan is clear. You want to make sure that you know exactly what you're doing and that you're not just guessing how much money you're going to start leveraging and how often you're going to do it and so forth. You have to have a plan. And that's what we do with our business owners. We go, okay, how do we take this retained earnings? How do we get as much of your retained earnings in a safe manner into this asset that you now know those retained earnings, whether you choose to use a leverage strategy now, 5 years from now, 15 years from now, when you're in your quote unquote financial freedom years, or when you pass on, you know that you've created an exit plan for those retained earnings in a much more tax efficient way. Now, for you and I, John, we don't leverage personally against our policies in the corporation. We leverage in the corporation in order to buy more assets because we don't have a need for that on a personal level yet. However,
someday we will.
Plan is that we will be using a leverage strategy down the road when that personal income is sort of a need or a want of ours, rather than us pulling money and then getting it chopped at the legs like most actively earned retained earnings have happened to them.
Love it. Love it. So what I'm hearing is if I own a corporation right now and I have some retained earnings and I'm concerned about, what I'm going to do with them in terms of tax, my best bet right now is to figure out, how do I move this? And this is where this guidance comes in. How do I move this into a whole life policy or a permanent insurance policy so that I can eventually leverage or utilize some strategies that will help me reduce how much of that pot would go to the government and stay within either my family or to myself personally later in life. And that's what I just heard from you. So if I've got that issue, then I want to choose to utilize that strategy as one of the, a really an efficient way to make that happen.
Exactly. And, again, there's some other reasons why you might put policies that are longer or larger than, say, your retained earnings. But at minimum, getting a strategy for those retained earnings is a really important piece. And then in future episodes, we'll talk about how policies may help us deal with some of the capital gains sort of taxes later for your estate, if that's of value to you and something that's important to you and your estate.
Awesome. So if you've got some value out of today's episode, we encourage you to hit the subscribe button, rate or review if you listen to any episodes before. That helps other Canadian investors, business owners, entrepreneurs find the episode so that they can also learn about the secret sauces that we talk about here on a weekly basis. Every Wednesday, we're putting out those episodes. So hit the rate and review button and also subscribe.
And if you are looking to hop on a discovery call, you've heard something here. If you're an incorporated business owner or an investor and you are looking for how you can have more tax efficient wealth secret sauces added to your strategy, reach out at CanadianWealthSecrets.com/discovery. That's CanadianWealthSecrets.com/discovery. And I look forward to chatting with you soon.
Just as a reminder, the content you heard here today is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.
All right, Canadian Wealth Secret Seekers. We'll see you next time.